Welcome to the Pro Ticker Deep Dive. Today we are exploring uh, a, a massive real-time collision between high kinetic global warfare and decentralized digital finance.
Yeah, it's a topic that really forces you to reevaluate everything you thought you knew about market structures.
Exactly. And I want to paint a picture for you. Imagine waking up on a Saturday morning. You check your global feeds, and the entire geopolitical landscape has just fractured overnight. We're talking about the most significant Middle Eastern conflict in decades.
Right, the escalation was just unprecedented.
Unprecedented. But here's the catch. Traditional stock markets, they're closed. The banking rails are completely shut down for the weekend. The bond markets, commodities, all the standard barometers for global panic,
We're completely frozen.
frozen. So the sheer unadulterated panic of a global capital flight has literally nowhere to go but the only market on Earth that operates continuously, 24 hours a day, 7 days a week.
The crypto ecosystem.
Exactly. Okay, let's unpack this because the capital rotation and the systemic stress testing we witnessed over those 48 hours, it really offers a masterclass in modern market structure.
It really does, because that weekend liquidity vacuum,
Mm.
it creates this fascinating pressure cooker for capital. I mean, we witnessed a scenario where a decentralized network had to absorb the shockwaves of a major kinetic war with zero circuit breakers.
No exchange halting at all.
None. And absolutely no central bank intervention to smooth out the volatility.
Right.
The core paradox we really have to unravel today is the anatomy of that market's reaction function.
Right.
How does a global asset class shed billions of dollars in market cap in a matter of minutes on Saturday, only to execute a flawless V-shaped recovery back to $68,000 by the Monday morning U.S. equity open?
It's wild to even think about.
It forces a complete reevaluation of how risk is priced during off-hours geopolitical black swans.
And this is precisely why you need to care about this dynamic, regardless of your personal exposure to digital assets. Whether you're managing a traditional 60/40 equities portfolio or, evaluating supply chain risks, or simply trying to understand the macroeconomic trajectory of the next decade.
Because this isn't just about the fiat denomination of a digital token.
No, not at all. We are analyzing the mechanics of how money, institutional power, and human survival operate when conventional systems fail. When legacy infrastructure shuts its doors on a Friday at 5 p.m., the decentralized networks are forced to carry the entire weight of global anxiety.
To accurately analyze that market reaction, we have to first establish the precise sequence of the geopolitical catalyst.
Let's get into the timeline.
Right. So on Saturday, February 28, 2026, the United States and Israel initiated a highly coordinated multi-domain military campaign against the Islamic Republic of Iran.
Officially designated as Operation Epic Fury. And the scale of Operation Epic Fury was staggering. This extended far beyond typical proportional responses. We were looking at a target matrix of over 1,000 individual installations.
The strike package was totally systemic. They dismantled over 200 Iranian air defense systems just to establish localized air superiority.
Right, before hitting the deeply entrenched strategic assets. They targeted the Kerman Air Base, heavily degrading their aerial projection capabilities, and they executed precision strikes on the Malik Ashtar University Aerospace Complex in Tehran.
Which effectively neutralized a central node of their ballistic research and development infrastructure.
But the most geopolitically significant outcome of those strikes, we have to talk about the decapitation of Iran's supreme leadership structure.
Yes. The operation resulted in the death of Iran's supreme leader, Ayatollah Ali Khamenei, alongside over 40 senior officials who were reportedly gathered when the initial ordinance was delivered.
And just to be clear, we are reporting these military actions with strict neutrality here. We're taking no sides, simply stating the factual timeline of events as they unfolded over that weekend.
Of course. And factually, the targeted removal of a nation's sovereign leader introduces a paradigm-shifting variable into regional stability. It instantly creates a profound power vacuum.
It triggers immediate succession protocols while simultaneously throwing the entire command and control apparatus of their regional proxy network into absolute disarray.
And the immediate counteroffensive was swift. Iran and its allied proxy networks launched waves of ballistic missiles and loitering munitions.
The targeting vectors included Israel, but more critically for global macro stability, they directed fire at U.S. military installations distributed across the Gulf.
We saw impacts confirmed in Kuwait, Bahrain, Qatar, and the United Arab Emirates.
Tragically, this retaliatory phase resulted in the deaths of 6 U.S. service members. The gravity of this escalation, a direct kinetic exchange involving sovereign leaders and multinational casualties, it fundamentally altered the risk profile of the entire region.
And that physical escalation translated instantaneously into macroeconomic risk pricing. When you map the trajectories of the retaliatory strikes across the Gulf, the primary focal point of systemic vulnerability becomes the Strait of Hormuz.
Which handles a massive amount of global trade.
Roughly 20% of the global oil supply transits through that maritime choke point. Any localized conflict that threatens to constrain that throughput, whether through a direct naval blockade or just the ambient threat of drone strikes on commercial tankers, it fundamentally alters the baseline inflation projections for the global economy.
I was also tracking some of the operational details that emerged during the initial hours of the conflict, and the integration of modern technology into the logistics is highly notable here.
Oh, the AI aspect.
Yeah, hours before the first kinetic strikes were even acknowledged, the U.S. government officially classified the artificial intelligence company Anthropic as a supply chain risk.
Right. The reporting indicates that their proprietary large language models and back-end software were actually utilized in the logistical planning and execution of the military operations.
We are literally watching algorithmic logistics, high kinetic warfare, and digital finance collide in real time.
It highlights the
Right. At 5 p.m. on Friday, the toll booths lock, the barriers come down, and the highway is closed. When a crisis of this magnitude detonates on a Saturday, all of that heavy traffic, the panicked selling, the desperate hedging, it is violently detoured onto a single, unpaved dirt road.
the crypto markets.
Yes, it's the only venue open, and it is forced to absorb a volume of traffic. It just isn't structurally designed to handle all at once.
And that structural bottleneck resulted in a textbook liquidation cascade.
Walk us through those first 15 minutes.
Within 15 minutes of the initial strike announcements proliferating across unstructured social media feeds, the market capitalization of Bitcoin suffered a violent contraction. We saw algorithmic bid stacking dissolve in real time as the price plunged from roughly $68,000 down to an intraday low of $63,177.
15 minutes to shed nearly $5,000 in value. The velocity of that capital flight is what really stands out in the on-chain forensics.
It is the brutal efficiency of automated risk engines reacting to sentiment analysis. The collateral damage to leveraged positioning was absolute.
Over $100 million to $200 million in leveraged long positions were wiped out almost instantly.
Forcibly unwound by exchange matching engines. And broadening the scope beyond just Bitcoin, the aggregate digital asset ecosystem saw $128 billion in total value evaporate in that same time frame.
Ethereum broke structural support, dropping sharply to $1,841.
High beta alternative assets like Solana and XRP suffered even steeper correlated drawdowns.
I looked closely at the order book data during that specific 15-minute window. We weren't just seeing spot selling. We were watching the mechanics of open interest wipeouts and funding rate inversions.
The market had been aggressively positioned throughout early 2026, heavily utilizing leverage to maintain long exposure.
And when the geopolitical news broke, the initial algorithmic spot selling pushed the price just low enough to hit the first major cluster of margin calls.
And that is the catalyst for the cascade. The exchange's automated risk protocols do not account for geopolitical context. They simply execute forced liquidations when collateral thresholds are breached.
It's totally mechanical.
Exactly. That forced selling into a thin weekend order book drives the spot price down further, which subsequently triggers the next, deeper tranche of margin calls. It is a self-sustaining loop that flushes out excess leverage until it finally finds a bedrock of unleveraged spot demand.
This specific weekend, price action immediately reignited the institutional debate regarding asset classification. We are constantly evaluating whether Bitcoin functions as an uncorrelated digital gold or a high beta risk asset.
Well, during the initial shock of Operation Epic Fury, it undeniably traded like a hypersensitive risk asset.
It absorbed the brunt of the global panic, while physical gold, once traditional markets opened, gapped significantly higher. Physical gold surged past $5,139 an ounce.
The initial correlation to risk-off assets is undeniable during that acute phase of the panic. However, to evaluate its ultimate utility, we have to look beyond that 15-minute liquidation wick. By Monday morning, as traditional Wall Street institutions brought their terminals online, Bitcoin had already initiated a massive structural reversal.
Here's where it gets really interesting.
It climbed right back to the $68,000 level, effectively erasing the weekend capitulation.
Despite the bloodbath on Saturday, by Monday, Bitcoin is back at $68K. How does that happen?
The V-shaped recovery wasn't driven by retail speculation. It was driven by two deeply divergent asymmetric forces operating at opposite ends of the global economy.
Let's break down the first force. Western institutional diamond hands. Going into that Monday, March 2nd equity open, the consensus expectation was that U.S. spot Bitcoin ETFs would suffer massive redemptions.
Portfolio managers de-risking their exposure in light of the war.
Right. Instead, they aggressively bought the drawdown. U.S. spot Bitcoin ETFs recorded a staggering $458.19 million in net inflows on that single day.
That volume of capital deployment completely reversed the prevailing macro trend. Prior to that Monday, those same ETF products had endured a grueling 5-week streak of consecutive outflows,
Bleeding approximately $3.8 billion in total withdrawals.
The fact that an escalating kinetic war served as the catalyst to arrest a multi-billion-dollar outflow trend is highly irregular for a traditionally classified risk asset.
The breakdown of those ETF flows reveals the concentration of that demand. BlackRock's IBIT ETF alone absorbed over $502 million in fresh capital on Monday.
In parallel to the ETF authorized participants executing those creations, we saw aggressive corporate treasury action.
MicroStrategy.
Yes, executing under Michael Saylor's ongoing capital allocation mandate, they acquired an additional 3,015 Bitcoin for approximately $204 million.
Pushing their total corporate reserves to over 720,000 Bitcoin.
If we connect this to the bigger picture, this capital flow data indicates a fundamental psychological and structural shift in how institutional allocators classify this asset.
Historically, a Middle Eastern conflict of this magnitude would trigger an immediate liquidation of any volatile, non-yielding asset.
But today, institutional capital managers are clearly utilizing major geopolitical drawdowns as high-conviction entry points. They are treating the asset not as a fringe speculative play, but as a strategic long-term portfolio hedge.
It validates the framework previously outlined by BlackRock CEO Larry Fink. He has publicly transitioned from skepticism to describing Bitcoin as a legitimate international asset that is functionally digitizing gold.
When the largest fiduciary managers in the world identify a $63,000 valuation during a global crisis as a structural discount, it establishes an incredibly resilient bid beneath the market.
That institutional bid stacking represents the Wall Street side of the equation. But to fully understand the Monday recovery, we have to pivot from the boardrooms of Manhattan to the localized reality on the ground in Tehran.
The Iranian financial exodus.
Exactly. This second force is rooted in raw, immediate human necessity. While portfolio managers were executing ETF creations, the physical infrastructure of Iran was under bombardment. Consequently, the local fiat currency, the Iranian rial, suffered a catastrophic devaluation.
It collapsed to an exchange rate of 1.4 million rials to a single U.S. dollar.
The destruction of local purchasing power in a conflict zone is devastating.
When the airspace is contested and the sovereign state is under attack, the centralized banking infrastructure becomes entirely compromised. Capital controls are instantly enacted. Bank withdrawals are frozen.
The physical logistics of moving traditional wealth, like transporting physical gold or foreign fiat banknotes out of a war zone, become a fatal risk.
So people look for alternatives.
I was analyzing the on-chain flows for Nobitex, which operates as Iran's largest centralized cryptocurrency exchange. The data paints a clear picture of capital flight. Within minutes of the military strikes being confirmed, Nobitex experienced a 700% spike in capital outflows.
A 700% spike.
Approximately $7 million in digital assets was drained from the exchange's hot wallets within 24 hours. And the destination addresses are what matter here.
Right. This capital wasn't being routed to local bank accounts.
It was being meticulously transferred into self-custody digital wallets.
This represents the brutal intersection of decentralized financial theory and localized reality. For the civilians executing those transfers, cryptocurrency is stripped of all its speculative Western narratives.
It is no longer an inflation hedge or a portfolio diversifier.
It is a borderless, permissionless financial lifeline. When a state's economic apparatus fails, a decentralized ledger offers the only mathematically secure exit ramp. It provides a localized populace with an asset that cannot be arbitrarily inflated by their failing central bank.
It cannot be seized by domestic capital controls.
And critically, it cannot be physically destroyed by a kinetic strike on a banking data center.
The dichotomy is profound. You have a single digital asset that simultaneously serves as a high beta volatility instrument for algorithmic trading desks in New York.
And a non-sovereign lifeboat for civilians navigating hyperinflation and physical bombardment in the Middle East.
That convergence of grassroots, necessity-driven self-custody, and massive Western institutional dip buying is the exact mechanical engine that generated the V-shaped recovery on Monday.
The contrast between physical destruction and digital resilience is really stark here. While physical power grids in Tehran were failing under kinetic strikes, we saw a completely different reality play out on the Bitcoin network's decentralized grid.
This is a critical vector to analyze because Iran is a significant participant in the global digital asset mining sector.
They are deeply entrenched in the infrastructure layer.
The Iranian government heavily subsidizes its domestic energy sector, allowing state-sponsored mining operations to process blocks at an incredibly low operational cost. It's estimated at roughly $1,300 per mined coin.
Because of this energy arbitrage, Iranian facilities historically contribute between 2 to 5% of the total global hash rate securing the network.
So when Operation Epic Fury systematically targeted the Iranian national power grid, a substantial portion of that state-sponsored computing power was instantly severed from the network.
In a centralized system, losing 5% of your global processing infrastructure in a matter of hours would trigger massive service degradations.
Outages everywhere.
Exactly. Yet the on-chain metrics show that the global Bitcoin network maintained perfect operational continuity. Despite the localized blackout, the aggregate global hash rate rapidly stabilized and rebounded to maintain an output of around 1 zettahash per second.
Sustaining 1 zettahash per second under geopolitical duress is a testament to the protocol's anti-fragility. And this is why you need to care about the math here. If a country's power grid gets bombed, traditional banking goes down. But Bitcoin's code automatically adjusts to keep producing blocks.
It's the difficulty adjustment algorithm.
Right. It's a system designed to survive kinetic warfare.
The protocol is mathematically constrained to produce a new block of verified transactions roughly every 10 minutes. If a sovereign state's mining fleet is suddenly knocked offline by military strikes, the aggregate computational power attempting to solve the cryptographic hashes drops.
Theoretically, this should increase the time it takes to process blocks.
However, the system is designed to self-correct. Every 2016 blocks, the protocol evaluates the aggregate hash rate and automatically recalibrates the cryptographic difficulty.
If miners fall offline, the algorithm lowers the difficulty, ensuring the 10-minute block interval remains constant.
And we saw this exact mechanism stress-tested just weeks prior to this conflict.
Following a massive U.S. winter storm earlier in the year that forced significant domestic mining curtailment, the network executed an upward difficulty adjustment of 15%.
Bringing the metric to 144.40 trillion.
The largest absolute upward adjustment in the network's history.
It perfectly illustrates the dichotomy between legacy infrastructure and decentralized consensus. If a nation's physical banking servers are compromised, the velocity of money drops to zero. Commerce halts. But a decentralized ledger utilizes dynamic algorithmic difficulty to ensure that the destruction of localized nodes never halts the global settlement layer.
The network inherently assumes physical infrastructure will fail and prices that failure into its operational code.
While the primary settlement layer demonstrated absolute resilience, the application layer of decentralized finance exhibited some highly controversial market behavior over the weekend.
Yes, I want to shift our analysis to the specific on-chain data emerging from decentralized prediction markets. The trading volume and wallet forensics on platforms like Polymarket suggest a deeply unsettling reality about information asymmetry during wartime.
The data from Polymarket requires rigorous analysis. For context, these are decentralized platforms utilizing smart contracts to facilitate binary options trading on real-world outcomes.
During the acute phase of Operation Epic Fury, Polymarket processed a record-breaking $478 million in single-day trading volume.
Essentially serving as a financialized betting market for sovereign conflict.
The volume is staggering, but the specific wallet behavior prior to the military action is what warrants serious scrutiny. The blockchain forensics isolated a specific wallet operating under the pseudonym Roiha 2026.
The on-chain timestamps on that are fascinating.
The wallet was created exactly 11 hours prior to any official public notification or media leak regarding the strikes. Immediately upon funding, this freshly minted address deployed a $50,000 position predicting imminent U.S. military action against Iran.
And within hours, as the ordinance hit the targets, that position resolved with a 93% return on capital.
And that single wallet is not an isolated anomaly within the dataset. Another distinct entity, identified by the address FlightArtBall, successfully converted a $170,000 initial position into nearly $500,000 by accurately predicting the specific vectors of escalation.
Conversely, the zero-sum nature of these smart contracts ruthlessly punished incorrect macro assumptions.
An entity tracked as Annoying 123 had methodically accrued $2 million in profits over a 2-month period by continuously betting against a strike. When the bombs dropped, that entire position, totaling $6.5 million in capital, was lost in a single day.
This raises an important question concerning the intersection of cryptography and global intelligence. Are we seeing insider trading on a geopolitical scale?
I've reviewed the forensic clustering data provided by several on-chain analytic firms. They identified a specific cluster of 6 interconnected wallets that collectively generated $1.2 million in profit in the hours immediately preceding the news cycle.
The statistical probability of that timing, executed by freshly funded, interconnected addresses, heavily implies non-public knowledge. Are we witnessing the monetization of classified military intelligence on public blockchains?
The immutable nature of the ledger provides absolute proof of execution and timing, but the pseudonymous architecture makes it exceptionally difficult to attribute those trades to specific actors without sophisticated off-chain correlation.
The analytical implications are profound. Discussing the ethical implications, these decentralized prediction markets are essentially functioning as uncensored geopolitical oracles. They generate real-time, financially incentivized probability matrices for human conflict.
The incentive structures are entirely amoral. Proponents of these systems argue that by attaching a financial penalty to incorrect predictions, you strip away media bias and political posturing. You generate the most accurate, crowdsourced intelligence apparatus on Earth.
You are essentially aggregating dispersed global knowledge into a single, highly efficient price feed.
That is the efficient market hypothesis applied to warfare.
However, the secondary effects require critical evaluation. If a global pseudonymous market offers deep liquidity for capitalizing on classified knowledge, it introduces a severe financial incentive for intelligence leaks.
It forces us to evaluate whether military strategists, diplomats, or deeply embedded intelligence assets are utilizing cryptographic obfuscation to front-run sovereign military operations.
It is a profound shift in how information asymmetry is priced.
But even if you completely ignore the mechanics of decentralized ledgers and prediction markets, the macroeconomic fallout from this specific weekend is aggressively transmitting into the traditional economy.
Let's pivot to the macro ripple effects and the Fed's dilemma, because the disruption in the Gulf is directly impacting global bond markets and central bank policy.
The primary transmission mechanism for that macroeconomic impact is the energy sector. Following the retaliatory strikes and the immediate threat to the Strait of Hormuz, we saw Brent crude pricing react violently. It flirted right with the $90 to $100 per barrel threshold. The derivatives market for maritime logistics priced the risk instantly. War risk insurance premiums for commercial oil tankers operating in the region jumped by 50%.
And how does this affect your wallet? The cascading effect of maritime insurance premiums directly impacts the consumer price index. When the operational cost to fuel and ensure the global supply chain spikes, that margin compression is passed directly down to the consumer.
The inflation alarms that the Federal Reserve had spent the last 2 years trying to silence are suddenly ringing across institutional trading desks.
The Federal Reserve operates on a dual mandate, but an exogenous energy supply shock severely limits their policy flexibility. An oil shock means higher for longer interest rates.
If we analyze the probability distribution on the CME FedWatch tool, it currently shows an 89% chance the Fed keeps rates unchanged at the 3.5% to 3.75% level in April.
The anticipation of prolonged restrictive rates creates deep structural issues for traditional capital markets. The yield curve inversion remains persistent, and institutional balance sheets are currently navigating severe liquidity constraints.
Compounding this macro tightness is the pending $175 billion tariff refund uncertainty currently under review by the U.S. Supreme Court.
That Supreme Court docket introduces massive counterparty risk into the corporate sector. When traditional institutions face a confluence of elevated borrowing costs, sticky energy inflation, and a looming $175 billion legal liability, their immediate mandate is to secure liquid collateral to raise cash.
In a constrained repo market, institutions increasingly turn to the most liquid, continuously traded asset available to raise cash on short notice. As the weekend demonstrated, Bitcoin frequently serves as that pristine collateral of last resort, which explains both the initial weekend liquidation and the aggressive Monday reaccumulation.
So where does the market go from here? We have synthesized the geopolitical triggers, the localized utility in Tehran, and the macroeconomic constraints dictated by the Federal Reserve. Let's ground this analysis in the technical realities.
The bear versus the bull.
Exactly. If we evaluate the current market structure by looking at the chart indicators, we are witnessing a severe conflict between macro bearish indicators and underlying on-chain bullish momentum.
Let's isolate the bearish chart patterns first. The market is currently showing a textbook bear flag consolidation.
This formation is materializing after a sustained 50% structural decline from the 2025 peak of $126,000. In traditional technical analysis, a bear flag in this context suggests a temporary equilibrium before a continuation of the primary downtrend.
I was also tracking the momentum oscillators on the higher timeframes, and the 3-day chart recently confirmed a death cross. The 50-period moving average crossed definitively below the 200-period moving average.
In a vacuum, that crossover suggests the macro downtrend has significant structural weight.
But the moving average crossovers are currently directly contradicted by several profound bullish signs. The most statistically significant metric currently flashing is the Bitcoin to gold Z-score.
Currently, that Z-score is at Nash's 1.24.
A Z-score pressing past -1 historically signals extreme undervaluation. It suggests that the correlation breakdown we saw over the weekend has pushed the ratio to a statistical extreme, implying a violent mean reversion is impending.
And beyond the quantitative data, we also have the bizarre blood moon cyclical theory.
The behavioral psychology of the market is fascinating here. The market experienced 2 distinct blood moons in 2025, and astronomical data confirms a third is imminent. Historically, these have coincided with cycle bottoms.
From a purely quantitative perspective, lunar cycles hold no fundamental correlation to algorithmic trading flows. However, market pricing is inherently reflexive. A significant cohort of retail and algorithmic sentiment tracking funds actively monitor these esoteric cycle theories.
Establishing a structural floor based purely on collective behavioral superstition. So what does this all mean?
We need to break down the critical levels. We are currently consolidating near the $68,000 pivot point. The absolute critical imperative for the bulls is holding the $65,000 support.
Dropping below $62,300 could open a technical trapdoor, rapidly exposing the market to downside price discovery toward $56,800, or even the ultimate macro floor at $41,400.
Conversely, reclaiming $68,500 flips the localized market structure. It clears the path back to the major resistance at $72,000.
To summarize this incredible dichotomy of the weekend, Bitcoin acted as a fragile risk asset for heavily leveraged traders, violently liquidating their positions without mercy.
Then, within hours, it transformed into a highly coveted, profitable dip-buying opportunity for Wall Street giants.
And simultaneously provided a literal, functional financial lifeline for civilians caught in a war zone attempting to preserve their wealth.
In an era of geopolitical fragmentation, understanding these digital systems isn't just about investing. It's about understanding the future of global infrastructure.
I want to leave you with a final thought to mull over. If decentralized financial networks and prediction markets can price in the exact timing of military strikes before the public even knows about them, are these networks simply reacting to geopolitics?
Or are they beginning to influence the speed and scale at which modern warfare is conducted? When the market doesn't just reflect the outcome, it inevitably becomes a participant in the process.
That is a profound structural shift to monitor. Thank you for joining us today as we navigated this incredibly complex deep dive. Keep questioning the consensus narratives, relentlessly analyze the underlying data, and stay sharply focused on how these systems evolve under pressure. We will catch you on the next one.